Well, hello there. Thank you so much for joining us. My name is Damon King. I'm a certified financial planner professional, licensed investment advisor, and licensed insurance professional with ChappelWood Financial Services. And we call this 3 Things in 3 Minutes. And today we're talking about market timing. 3 reasons why market timing just doesn't work. Market timing is when you're trying to buy and sell stocks based on what you think the market is going to do, as opposed to actual fundamental analysis, things of that nature. But if you're trying to buy and sell stocks on an hourly basis, daily basis, weekly, it doesn't matter. If you're trying to predict what stock prices are going to do based on what you think the market's going to do, you are market timing. There are 3 reasons why this just does not work. First of all, the market is irrational. Have you ever tried to have a logical conversation with a 3-year-old child? If so, you know it's like trying to wrestle with an angry badger. You're not going to logic your way out of that situation, okay? The market acts irrationally because we, human beings, act irrationally. We drive the market. Now, the common knowledge, for example, is to buy stock when it's down, right? Because it's got to come back up eventually. That's what we believe. But often the opposite is true. As a stock becomes more and more depressed, it becomes more and more difficult for that company to raise capital in the open market. And as a result, the price continues to go lower and lower. It's sort of a self-fulfilling cycle. So the common knowledge of market timers is buy low. Not necessarily. You could end up buying, you think it's the bottom, but it's really not. Number 2 are black swan events. These are unpredictable events that you have no way of seeing. They happen more often than you might think, as a matter of fact. These are things like natural disasters, political turmoil across the world, terrorist attacks, changes to our economic and fiscal policies here and abroad. Market timers don't factor these things into their plans, and as a result, they don't factor them because they don't think they're going to happen. And as a result, they get surprised. Let's go back to 2008. Everybody remembers 2008 if you were invested in the market. Market timers believed that the federal government would bail out Lehman Brothers. But guess what? They didn't. The federal government allowed Lehman Brothers to declare bankruptcy. But meanwhile, the market timers just kept buying and buying and buying. And when Lehman Brothers folded, so did their portfolios. So market timing can really get you into some big trouble if something happens and you have no way of predicting that it's going to happen. And third, you could miss big winners. This happens when market timers feel like a certain stock is at its peak. It's reached its peak, it can't go any higher, and then they sell the stock before it takes a nosedive. But what often happens, though, is that they miss the continued upswing. A perfect example of this is Tesla Motors. When Tesla came onto the market, it opened at $35 a share. Pretty soon it doubled to $70 a share. Many market timers at that time said, oh, that's it. This is as high as it's going to go. They didn't believe that Tesla could compete with the likes of Toyota or GM. Boy, were they wrong. Not only has Tesla continued to increase in stock price, right now, as of today, it's trading at around $250 a share. If you got out when it was at 70, you're probably kicking yourself. But the reality is that the stock price of Tesla is not bolstered by actual fundamental performance. It's been bolstered by perception. And again, we run the market. We control the market. And if our perception says that something's valuable, we're going to go buy it, and the stock price will go up. So the moral of the story here is that market timing almost always will cause you to perform worse than if you had just stuck to the 3 basics: a well-diversified basket of securities, accepting normal returns, don't get too greedy, and have a long-term view. So those are the 3 reasons why market timing doesn't work. Thanks so much for watching this episode, and be sure to check out Francis Tuttle's offerings of various classes we have on finance, and you can also check out the Rock Your Retirement Financial Enrichment Series. Thanks so much, and we'll see you next time.